What's going on? How we doing? Let's get to the action. You know the man himself, Tim Quast, is back with us. How we doing?
Hey, happy Monday, guys. Good to see you. Well, thank you. It's starting to get light in the background there, as you can see up here in the high country.
Go.
And we're leaving. We're headed down to Denver today. We've alas have to say goodbye to winter, and it's been winter.
How long have you been up there, Tim? You know, all the winter you stay up there?
A lot of it. Wow,
yeah. You live the dream, man.
Yeah,
I'm so jealous of your
living
life.
The dreams, man. Living the dreams.
He lives the dream. Up at the chalet, staying up there for months on
Tim,
end.
you ever need someone to watch that place? You know, you just holler.
I've had multiple offers. There's a queue, Mitch. So.
We're in the
I'm
queue.
sure
Put
there
me
is.
and Money Mitch in the queue.
We're at
the
stay
back
in the same room if we have.
We're your normal retail investors here, Mitch. We're at the back of the queue. I'm sure the high frequency traders at the front of the queue.
That's right.
Got to get out of Canada first,
We're hoping for some immediate or cancel orders so that Mitch can move up the queue.
And Joel, you don't have to worry. Dennis just comes over the mountain, and he's considered to be coming from Canada, so he just snowboards down.
I don't even need to get. I just snowboard the whole way there.
So Tim, was this rally the little guy, the retail guy, or the big boys?
Good question.
Well, you know, it is a great question, and obviously it depends on who you ask. But since you're asking me, I'll offer what I can see in the data, and I think it's important for traders to understand. By the way, if you want to, stay in Steamboat, all winter, use Market Structure Edge, and you can.
That's what I haven't been doing.
I haven't done that in a while. So
shameless pitch.
So Joel, here, we traded notes over the weekend, and there were Wall Street Journal articles over the weekend about how retail order flow, which was very strong in February, dropped dramatically in March by more than half. So if that's true, and I'm not saying it is, but let's suppose that it is, then we can't say it's the little guy that gave us this great March rally. Then there was another Wall Street Journal article, not that I'm pumping the Wall Street Journal, nor do I necessarily think that all their facts are right, but there was another article saying that institutional allocations to U.S. equities reached an 18-year low in March. So you could look at that and say, well, then how the heck did the market rally, right? If there's less money, how come there were higher prices? And to me, there's an answer that gets to understanding how the market works, which is very important if you're going to be successful in it. Traders, retail traders, that's you and me. What happens in the market? Well, a lot of the money, no matter how much the allocation may reduce or fall, a lot of money has to track a benchmark or a target date fund, and it's got to be square with those things by the end of the quarter. By which I mean that if you have, if Meta is 5% of the index that you're tracking, then by March 31st, it better be 5% of your holdings.
Right.
And it's very important to understand that. You can get in trouble with regulators if you're not there. And if you look at the underlying data, keep in mind, and Dennis, you pointed this out about large tech, but just think about this. Tesla and Amazon are part of the 8 largest holdings of the S&P 500, and they're in consumer discretionary. Consumer discretionary was the 3rd best performer. Meta is in communication services, as are a number of other stocks like that. Communication services was the number 2 best performer. Then you've got both Googles, Goog and Google, which are components. Apple and Microsoft are 13% of the S&P 500 by themselves. You add in Tesla and Amazon and NVDA. Believe it or not, NVIDIA is the 4th highest allocation in the S&P 500. Put all those together, 8 stocks, they're 25% of the S&P 500. So all you have to do is square yourself with the benchmark, and there's less money coming into the market and it soars. And it's very important not to get caught out by that stuff, folks. You want to know what's going on so that you know when to take gains, not chances. One of my
Would you be taking gains now?
Well, that's a great question. So I always, this is what I did for Edge users in the market desk note this morning. Let's take a look at what the money's doing.
Okay.
And if we do that, if I could share my screen, it would
Yeah,
be
let's please do.
There we go.
Let's do it.
And there we are. So now my visage gets older every day. It's disappointing to see myself and realize how deep the crags are on my face. So here's what I look at. The first of all, what's the big money doing? What are the general trends in the market? And this is from what I just discussed. They're pretty good. So here's the demand side, and there's the price of SPY. It shot up for the reasons that we just discussed. And at the same time, the supply side fell. So supply is short volume. And I won't, relitigate what all that is, but it's short. It's the percentage of the trading volume that comes from borrowed stock. So it came down pretty dramatically from about March 23rd to March 31st. It came down from 51.9% to 50.8%. It's still over half the volume. The market is still net short, which is kind of crazy when you think about it. And this trend line, I could back up all the way to the pandemic, and it has been steadily doing this. So diverging supply and demand will lift prices. That happens. But when levels still are above 50%, there is always the chance that the bottom falls out, even with these kind of divergences, because all it takes is for something to stop and the market can decline. What might stop? Well, all that rebalancing. If that stops, if it's finished on Friday, then trouble could develop very quickly.
How often do you see turns? I want to interrupt you here just to expand on this point. How often do you see turns at the end of the quarter like this? Because me and Joel selective perception here, we often talk about turns at the end of the quarter. Do the numbers show this? Do we actually often see turns at the end of the quarter? Obviously, we had the end of the quarter on Friday, which is why I bring this up.
Yes, we often do. We often do. Statistically, we've done some work on this. Statistically, the greatest changes occur at the end of the September quarter.
Okay.
But number 2 is March. And then December and June. If you were to rank them, that's what we have traditionally seen. And so I don't know. And if you look at the supply demand balance, it's not bad. I could look at consumer discretionary and consumer staples right here. I mean, it's a 30-day view, but that's a good read into the end of the quarter. What was happening? Stable demand, falling supply, but above 50%. There it is again. You look at consumer staples, rising demand just over 5, steeply falling supply, but it leveled off at 50%. The whole market is in effect net long short. I mean, it's perfectly hedged. Here, by the way, is tech. This is what did it. So that finished by looking at this data, it finished roughly the 28th, and demand began to fall. Supply came down a little bit too. It's not bad, but this is not the kind of condition that tends to lead to a surging market. It tends to mean that the market resets in some fashion. What about energy? You could look at energy, and oil's up 5% overnight on these cuts, OPEC plus cuts. Interesting timing, right? Interesting time. The Chinese meet with the Saudis, and then the very next couple of days they cut. You could think about, well, are there geopolitics involved? Probably. I look at energy and say it's not bad. It's got rising demand, and the 30-day trend in supply is down. It's still fairly high. Nothing is awesome, Dennis, but I would look at it and say, whatever drove the market up into March 31st, that is ended. And so now we'll move to something else. I don't know exactly what it's going to be. I can tell you what we look at, which is momentum versus, you could call it value, but we call it low volatility. Momentum, low volatility. Number of components, 7 in low volatility, 8 in momentum. For those either condition to be prevalent, that should be 20 or more. And so it's neither a momentum nor a low volatility market. So we'll see. I can tell you what I think one should trade, but I think there will be a change. I don't, it's not like I'd look at the data and go, wow, there's huge trouble, but it's hard for me to get really excited about these data that I see. I think supply is too high, demand is weak, there's neither momentum nor low volatility. What do you do as a trader? Well, you have to be very tactical.
Do you think we just have this range-bound market? That's what I've been calling for here,
Yeah.
and I was calling for it for a long time, and then the bank crisis started, and I was like, I'm kind of scared and just spooked. But now it just seems like the banks, you're not talking about them as much. Can we just be in a range for the foreseeable future here?
Well, it's possible, and we've talked about it. You've talked about it. A lot of people. Mike Santoli on CNBC points out that really for 200 days the market has been in the same range. You could even go all the way back a year ago. We were pretty close to the same levels.
Yeah.
So in a sense, yes, that is absolutely the case. What I always point out from a market structure standpoint is that a perfectly balanced market. So if we were at 5 and short volume was at 50, the market would decline. Why? Because there's intermediation. Now it's only in tiny pieces of pennies, but that's how Citadel made $16 billion last year. About a tenth to a hundredth of a penny at a time, and that will slowly erode the market over time. So why has it been able to hang around in this range? Well, I think it's the combination of three things. One, there's this continuous rebalancing. Are you more exposed to equities, more exposed to bonds? That helps. There are surges of momentum as things devalue. That helps. And there are inflows and outflows. There are people's 401ks. There are required minimum distributions. And those things, maybe there's a slight bias to money coming in versus money going out. The three things put together keep the market where it is. If any of those things change, then I think the market declines. I'm not neither negative nor positive on the market.
What about the financials? We were talking last week. We're like, the financials.
Right.
How can the market go without the financials? And boom, it went here. I don't know if you want to do an individual bank stock or whatever, but I'm just just curious about the market structure here for some of the financials.
Well, interestingly, the very best momentum stock in that momentum portfolio up there, which math just finds. It's a bunch of rules, and the math searches for it and furnishes it every day. By the way, on Friday morning, that portfolio jumped from 5 to 10. So we knew that there would be a brief burst of momentum, which there was on Friday. But then when the data refreshed, really Saturday morning, we could look at, well, now it's dropped back down. So I don't expect that burst. But look at this. So this is Truist Financial. And it was caught up in this bank crisis. You can see it right here. Demand had been at 5. All of a sudden, it got shorted heavily right here. So then the price comes down. Everybody covers right in here. Short hedges put back on following March options expirations. But look at the demand. So demand soaring, supply is falling. That tends to produce gains. Now, it might only be for 2 or 3 days, but it's very probable that one could get 2, 3, 4% in that. So is that a good indication of the condition of banks? No, I don't think it is, but you could look at that and say, well, Truist at least looks good for the short term. Could we draw any broader conclusions about financials? Well, not from the current data, but do I think that this problem is over? Well, nothing's changed. There's been no change to the balance sheets of banks that have problems related to the difference between long-term, low interest rate investments and shorter-term, higher interest rate obligations. That is not a good combo. And I think as this always happens, you have a couple of canaries in the coal mine, like in 2007, the 2 Lehman hedge funds that failed that had exposure to mortgage-backed securities. And we all went, I don't know what that was about. And then a year later, wham, the whole thing hit, right? So is it going to happen that way again? I don't know, but I don't think the banking crisis is over. And I think we have to be aware of that.
All right. Like always, you guys see this right here on the right-hand side. That's Market Structure Edge, of course. Check it out. Get your 2-week trial. Actually, you can get I think up to a month now. Just look down below. Look down below in the description, guys. Click that link. Go ahead and get your 30 days. You don't even need a credit card to check out the program so that you guys can see what Market Structure Edge has to offer. We'll have you back on next week. Always appreciate you, Tim. Enjoy that weather out there.
Have a